Hello, everyone. Jonathan Wells here. Welcome back to Loanology, the John Wells podcast. I am your host, Jonathan Wells. We're going to talk about, a lot of cool different things today. I actually want to preface this episode with saying that I'm doing something a little bit different, shaking up the method of how this works. So typically what I would do is go through like the drink reviews and like all these different things, right? But no, we're going to start going straight into the content, straight into the information you guys are interested in. I want to keep these podcasts around the 15-minute mark so that it's easier for people to digest and everything else, right? So if you're a fan of the podcast, please share it with people that you know. Just send it to 2 or 3 people, right? Let them know, hey, this is a guy that I listen to for finance and different tips on buying a home and things like that. And anything to support the podcast would be appreciated. So love it. Again, let me know if you guys have any questions. Please, if you want to be on the podcast, shoot me an email at JohnWells at leader, LEADER, the number 1.com. Put in the subject podcast guest, and I'd be happy to get you on. Some other things that are going to be developing here is that very soon, like potentially this week soon, I'll have access to the corporate podcast room that should be getting finished up in Oak Brook. So again, if you want to be a guest and do a video podcast, let me know. We'll get you on there. And then also I should be able to start editing those down to different reels, for Instagram, Facebook, TikTok, YouTube, all the different, social media platforms, and getting short form content out there as well. So you guys can digest that too. Would love to get any input or feedback as that is greatly appreciated. And let's start talking about really cool things here, which is the EPM or Equity Prime Mortgage Down Payment Assistance Program. So cheers. All right. So for those of you guys who don't know, if you're looking to purchase your first home, you can be using different down payment assistance programs. So a down payment assistance program, very simply, is a program that helps pay for your down payment and or closing costs that you can use towards purchasing a home, so you don't have to bring as much money to closing, right? So for example, just for super easy math, let's say that you're looking to purchase a $200,000, or let's say a $300,000 home, right? Looking to buy a $300,000 home, and you're going to put down 3.5% is usually the minimum that you do for times 0.035. For a first-time home buyer, typically putting down about 3.5%. That's $10,500 you'd be using just for your down payment, right? Now, you're also going to have different closing costs and things of that nature as well. So realistically, on a $300,000 home, it is not uncommon for you to bring about $20,000 total into the transaction, right? Now, a lot of people don't have $20,000, right? Maybe you have 15. Well, in that case, your agent would negotiate for a $5,000 closing cost credit from the seller to pay, maybe your, lender fees or your title fees or whatever, and bring it down to about, $15,000, right? And then you'll have a tax credit too. So you might go to about 12,000, right? So from the 20, you go down to about 12, just because you got a $5,000 seller credit from the seller and a $3,000 tax credit also from the seller. Now, let's say you wanted to use a down payment assistance program and they offered, a grant of 3.5%. Well, now you're only bringing like $2,000 to the table, right? In theory. So this is where down payment assistance programs can be very helpful for people that don't have a lot of cash, right? Like I always tell my clients, you should have around $10,000 saved for, your total all-in cost for your first home. If you don't have $10,000, there are still programs out there for you, right? But the less money you have of that $10,000, the harder it's going to be for you to get into a place, right? Again, not impossible. I've had people go to closing with no money down, right? But it's just not as easy, right? So let's talk about down payment assistance a little bit before we get into EPM. Most down payment assistance programs come in the form of a second mortgage, right? So you have your first mortgage, it's an FHA loan, you're putting down 3.5%, because you always put down a down payment, right? Regardless of what anyone tells you, unless you're doing a VA loan or a USDA loan, you are always putting down some money. It's just who is paying that money, right? So if you do a down payment assistance program, most of the time it's going to be an FHA loan, and you're going to take out a 96.5%, you know, loan of the property's value or your purchase price, whatever's lower, and then you're responsible for coming up with the other 3.5% for your down payment, right? Now, with that down payment assistance loan, they'll give you a second mortgage for, let's say, most commonly it's like either $10,000 or 6 grand, depending on what statewide program you do in Indiana or Illinois. And that would offset your down payment, right? So, IDA IHDA is for Illinois, IHCDA is for Indiana. And so, Indiana, it's 6% of the sales price. Illinois, it is $10,000 or 6%, whatever is lower, right? Or maybe 10% or $10,000. But either way, you're getting 10 grand because most people, the way that purchase prices are now, you're getting 10 grand. The percentages don't matter because it's the lesser of the two, right? So let's say you're doing that, and you've got it's a second mortgage. So for Illinois, it is repayable monthly. So it's at 0%, but you're paying back that 10 grand over the next 9 years every month. Whereas with the state of Indiana, it's a 6% grant. It's also a second mortgage. There's no payment due on it, but you do have to pay it off when you refinance the property, sell the home, or vacate the property as well as your primary residence, right? So those are all downsides because, again, with a lot of these down payment assistance programs, like, you save money out of pocket compared to what you would have had to put down with just a regular FHA loan. However, you also end up spending more over the long run because your fees are higher. These down payment assistance programs know that they're pretty much the only ones that do this on the market in most cases. So they're going to charge you for that. And then also you have to pay that back anyways, right? Like, it's not free money. It's still a repayable deal. So it's not like the most cost effective, if you will, when it comes to, different financial options that you have, right? Like, you're paying more over the long run, to my point. But I do tell clients this: if it's the only way that you can buy a home is to use a down payment assistance program, you should look at a down payment assistance program, instead of renting for the rest of your life, right? Like, it's not the end of the world if you do a down payment assistance program. However, if you have the capability of putting down some money, and you have the capacity to do that, I definitely recommend putting down money as opposed to using a down payment assistance program. Because, again, every single one of those is going to have their trade-offs, and it's not always the best option for you as the consumer, right? But I digress. So let's say you're looking for a down payment assistance program and you don't want to have to pay it back, right? This is where EPM comes in. So different private organizations come through and they'll create different down payment assistance programs for my clients. So the reason why I love EPM is because, one, I can broker to them, right? So you guys can come to me and I'll close the loan through Equity Prime Mortgage, but I'm still Jonathan Wells, branch manager at the John Wells Group, powered by Leader One Financial, right? So you can still broker, I can still broker the deal, still have that done for you guys. And I just think that the product itself is way better than any other down payment assistance program that I've seen before. So it's for only primary residences, which every single down payment assistance program is going to be for only primary residences. You can purchase a 1 unit or a 2 unit, right? So a lot of the down payment assistance programs cap at 2 units. They don't want you buying a 3 or a 4-plex because, they're not dumb. They know you're buying it so that you can move out in a year and collect that rental income, right? So they're not going to want to do that. So they're going to keep you to 1 to 2 units. 580 minimum credit score, right? So with a lot of the down payment assistance programs out there, they require a minimum of a 640. So this minimum is 60 points lower than what the average, first time home buyer grant program is set at, right? Also, they'll go up to a 49.99% debt to income ratio, which means that basically it's anything under 50, right? So that's going to help you get something that's more affordable, or that, at a higher price point, right? If you're looking for qualifications. Let's say you make, let's just say 5 grand a month, right? So if you did that, times, point 4000499. No, that's not right. It should be 290. Is that right? $295? Yeah. $295 more that you can get in like you can have in debt load, right? Which would give you an approval, I would say roughly about $20,000 to $25,000 higher potentially, depending on everything else, right? But again, you can have a higher approval with this program than you can with any other program out there. And they'll also do manual underwrites, like any down payment assistance program like IDA or IHCDA or anything like that. They will not do down payment assistance programs, they will not do manual underwrites. So meaning that like you have to be a straight approved eligible like A1 type kind of client, right? Whereas with this program, you don't have to have everything together. You can be a bit of a mess, right, and still get into this place. So that's why I like it. It's better than the other down payment assistance programs for the reason of debt to income, credit scores, amounts, manual underwrites, etc. Right? So, does this apply to you? Would this be a good fit for you as a client? Right? Well, it would be a great fit if you're a first-time home buyer. If you have, I would say, at least $6,000 to $7,000 to put down. You can get away with doing less, right? As always, there's an exception to every single rule. But in most cases, most of my clients are putting down about $6,000 or so using this program, right? Um, and you want a little extra money to close, things like that, right? So, what are the trade-offs, right? Like, what are the catches? Every single program has a catch, right? What are said catches? So, for this program, the biggest thing that I do just tell you off the bat is it's going to be a higher interest rate than other programs you may have available to you, right? Now, that's not necessarily the worst thing in the world because let's say, the rate right now, like as of today that I just locked a client in at, it's posted on their website. I don't want to give too much information, but it's, let's say it's just under 8%, right? It's not the most ideal rate when, some other interest rates may be lower than that by, half or a whole percent or whatever, right? But you're getting free money. So take it, right? And then, after 6 months, you can refi with this program. It's completely forgiven at closing. There's no repayment on it. So you can refinance in 6 months and you'd be fine, right? So that's why I tell my clients, get the deal now. And then in 6 months, I'll call you. We'll take a look at a refi. If it makes sense, let's do it. Let's go through whatever, right? Now, the other thing too that I like about it is that it is, the other catch about it too. So higher interest rates, the first one. Second catch is it's a brokered loan. So I have to charge to the client my broker fee on the deal, right? So that's gonna be a couple grand, depending on your loan amount, whatever it is, right? That's gonna get charged to you. So a lot of the times it doesn't like actually fully offset everything. So if you would have just put down a regular FHA loan and just done it that way, maybe you're paying 20 grand to get into the home, minus any tax credits, minus any seller credits. With this one, you might be paying 17,000 to get to closing, minus tax credits, minus seller credits. But the nice thing is about this program is that it takes away the need for what's called the minimum required investment. So the minimum required investment is what you're putting into the deal for your total 3.5% down payment if you're doing an FHA loan, right? So let's say your minimum down payment or your minimum required investments, your down payment of $10,500. You have to put down $10,500 over the course of the transaction. You can't not put that much in, regardless of how much you get for seller credits, etc. So what you're like, you have to bring that money to the table. Whereas with this program, that money is already coming from EPM as a grant. So you could bring 8,000 to closing, or you could bring 5,000 to closing. It just depends on how much you get from the sellers and seller credits to offset the closing costs that you have, right? So if you want to zero out your cash to close and not bring anything to the table, I'd recommend doing about 5% back of your sales price in seller credits, which really should offset pretty much everything you're paying on that deal, right? So, I hope this makes sense. Like if you guys are interested in looking at different loan options that can help you with creative solutions, whether it's a down payment concern you maybe don't have that much saved, or a monthly payment concern, you don't have that much to spend per month, or just general questions or anything in between, right? Feel free to reach out to me. Shoot me an email, John, JONWELLS, at leader, LEADER, the number one.com. And, if you got all the way through here, please share this with 2 to 3 friends. I would love, to have the engagement, and it would just really support the podcast here. I greatly appreciate it. Please, again, let me know if there's anything I can do, and I will talk to you guys in the next episode. Cheers.